Jamie Dimon just said something that should make every American pay attention. The guy who runs the biggest bank in the country is warning about a $2 trillion problem that most people don't even know. And here's the scary part. Your retirement money is probably caught right in the middle of it. I'm going to explain this because Wall Street doesn't want you to understand what's really happening. They've built this massive lending system that operates completely outside the normal banking rules. It's called private credit, and it's now bigger than the entire junk bond market. We're talking about $2 trillion. That's more money than most countries have in their entire economy. Here's how this whole mess started. You know how regular banks have all these rules about who they can lend money to? Well, some smart guys on Wall Street figured out they could make a lot more money by lending to companies that banks won't touch. These are companies that are losing money, companies that are drowning in debt, companies that probably shouldn't exist in the first place. But these private credit funds aren't using their own money to make these risky bets. They're using money from pension funds, insurance companies, and retirement accounts. Your money, my money. Money that's supposed to be safe and secure for when we get old. Think about this for a second. You've been paying into your 401k for years, thinking you're being responsible and planning for retirement. What you don't know is that your money managers are taking chunks of that money and lending it to companies that are basically financial disasters waiting to happen. And they're charging these companies 15%, 20%, sometimes even higher interest rates because everyone knows these loans are super risky. Jamie Dimon has seen this movie before. Back in 2008, it was mortgage companies lending money to people who obviously couldn't pay it back. They packaged up all these bad loans and sold them to investors as if they were safe investment. That's exactly what's happening now, except instead of houses, it's companies that can't make money. The big difference this time is how connected everything is. In 2008, the problem was mostly in housing and mortgages. You could kind of contain it to one part of the economy. But private credit is everywhere now. It's in your state pension fund, it's in your life insurance policy. It's in those conservative bond funds that are supposed to be the safe part of your portfolio. And get this, the people running these funds know exactly what they're doing. They're not stupid. They know they're making risky loans to companies that might not survive. But they're getting paid huge fees either way. So why should they care if your retirement account takes a hit? The Federal Reserve keeps trying to warn people about this, but nobody wants to listen. The IMF, that's the International Monetary Fund, they're saying private credit could be the thing that triggers the next big financial crisis. Even the credit rating agencies, the same ones who completely missed the 2008 crisis, are starting to sound the alarm. But investors keep throwing money into this stuff because they're desperate. Interest rates on safe investments like CDs and treasury bonds are finally decent, but they're still not keeping up with inflation. So people are reaching for higher returns, and private credit looks attractive because it promises 10% or 12% annual returns. Here's what's going to happen, and it's not pretty. All these companies that borrowed money at super high interest rates are going to start having problems. When you're paying 18% interest on your loans and you're barely making any profit, it doesn't take much to push you over the edge. A recession, higher costs, losing a big customer, any of these things can trigger a wave of bankruptcy. And when companies start going bankrupt, those private credit funds are going to lose massive amounts of money, which means your pension fund loses money, your insurance company loses money, your 401k loses money. But here's the really ugly part. You won't even be able to get your money out when you want to. See, when you own stocks, you can sell them any day the market is open. When you own regular bonds, same thing. But private credit investments are what they call illiquid. That's a fancy way of saying your money is locked up for years. So when the panic starts and everyone wants their money back, you'll be stuck watching your account balance drop, and there's absolutely nothing you can do about it. Jamie Dimon isn't just some random guy throwing around scary predictions. This is a man who's been in banking for over 40 years. He lived through the savings and loan crisis in the 1980s. He saw the dot-com bubble burst in 2000. He guided JPMorgan through the 2008 financial crisis when other big banks were collapsing. When someone with that kind of experience starts talking about hell to pay, you should probably listen. And he's not the only one who sees what's coming. Corporate insiders are quietly selling their stakes in private credit companies. Big hedge funds are reducing how much money they have in this market. It's like 2007 all over again, when everyone thought mortgage investments were perfectly safe right up until they crashed. The really frustrating part is that regular people are the ones who are going to get hurt the most. The Wall Street guys who created this mess, they've already made their money. They get paid whether these investments work out or not. But working families who trusted their retirement savings to professional money managers, they're going to watch years of careful saving disappear. So what can you actually do about this? First, you need to find out if your retirement money is invested in private credit. You might want to check if your 401k has private credit exposure. You have a right to know where your money is. Second, if you're working with a financial advisor who's been pushing alternative investments on you, start asking harder questions. What exactly are you investing in? How risky is it? Can you get your money out if you need to? If they can't give you straight answers, maybe it's time to find someone who can. Third, many experts suggest maintaining some cash reserves during uncertain times. I know it's tempting to chase higher returns, but when this private credit bubble bursts, cash is going to be king. There are going to be amazing buying opportunities for people who have money available when everyone else is panicking. Look, some people think the answer is to panic and liquidate everything. But you should understand what's happening in the financial system. Jamie Dimon is trying to warn people that we've created another massive bubble, and this time it's sitting right in the middle of everyone's retirement account. The choice is yours. You can pay attention to what the smartest people in finance are saying, or you can keep hoping that someone else is looking out for your financial future.